I think we have both good news and worse news from Europe. The good news is that disinflation is on track. That's important. It's improving the real incomes of our households and citizens. Also, employment has remained overall quite robust. On the other hand, we see a weakened growth outlook, and we see that productivity growth is the Achilles heel of Europe. So it's been one factor that prompted us to decide rate cuts last week to cut rates by 25 basis points in Europe, because disinflation is on track and because we are seeing a weakened growth outlook, which is also increasing disinflationary pressures.
After the ECB press conference last week, the market was left wanting. It got one message loud and clear of data dependency and a meeting-by-meeting approach. Does it make sense to reduce rates by another 25 basis points in December if the data looks like it did coming up to the last meeting?
The direction is clear. We are continuing the rate cutting cycle. The speed and scale of rate cuts depends on the incoming data. And we are looking in particular three factors, three variables in this regard. First, the inflation outlook. Second, underlying inflation, i.e. neutralized from energy and food prices. And third, the strength of monetary policy transmission. That's data dependency. For me, it is not certainly any kind of data point dependency. It's even more, I would say, analysis dependency, so that you analyze the overall development, the trends in inflation, growth and other factors, and you also look forward. And we will get our next major economic projection in December.
The market has taken the first back-to-back rate reduction in 13 years as a sign that it can now price in rate cuts at every meeting out until about mid next year. How comfortable are you with that market pricing?
I don't usually comment on market pricing. I let the market forces do their job. My job is it's to prepare decisions on my behalf and try to influence that in the governing council of the ECB. In my view, meeting by meeting means that we can take decisions. Actually, we take decisions on policy rates at every meeting of the governing council, whether we keep them at the previous level or whether we reduce or increase them. That's always depending on the incoming data. As I said, now the direction is clear. We are in a rate cutting cycle as disinflation is on track, but the speed and scale will indeed depend on the incoming data and the analysis we are doing.
Well, let me tackle speed with you, because 25 basis points, that size reduction, was the only option put on the table by Philip Lane at your last meeting, according to Christine Lagarde in the press conference. Does it make sense to have a 50 basis point reduction as one of the options to debate in December?
I think it's premature at this stage to go into the question of whether it should be 25 basis points or 50 basis points or something else. We are indeed practicing data dependency, and I want to practice what we preach. So we will see how the economy is evolving at that time in December when we take decisions.
What is the hurdle to a jumbo-sized rate reduction? Because the Federal Reserve recently proved to us that it could enact a supersized rate reduction without spooking the market and not having an emergency setting, that it was simply about getting back to neutral quickly. What do you make of that type of communication we've had from the Fed, and whether it does buy you some cover now?
I think the Fed and the ECB are in different contexts for the moment. The US economy and the European economy are in different places. US economy is still growing fairly strongly, and disinflation is taking place there as well. In Europe, we have more challenges with our growth outlook, and also because of weak productivity growth. which has several background reasons. One factor is energy prices. We have been able to overcome the energy crisis by and large in Europe, which was caused by Russia's illegal, brutal aggression in Ukraine, the war in Ukraine. But still the energy prices are higher in Europe than in the US on average, and that is a drag on Europe's cost competitiveness.
There's no doubt there are many different factors at the moment. It's a very difficult environment trying to forecast where we're going. But Christine Lagarde last week at the press conference admitted that the ECB did not anticipate the scale of decline in September inflation. What's the risk now of undershooting on inflation, even with this expectation there might be a slight bump higher in inflation near term?
We have seen indeed reduction in the inflation figures. The latest reading is 1.7% in headline inflation in September. That's good news. This inflation is on track and the real incomes of the households are increasing. On the other hand, we have to monitor very carefully how inflation will evolve, and we have to be mindful of the risk of undershooting. On the other hand, I have to say that service inflation is still quite elevated. It's close to 4%, and we've seen rather rapid wage growth, even though that is slightly declining for the moment. So there are factors going to different directions, which also make the case for data dependency in December and in every meeting of the Governing Council.
But the heat and services inflation is largely due to the wage pressure that you've seen, which in some ways is a lagging indicator, as you've seen labour forces catch up to the spike that we had in inflation in the yesteryears in recent years. Doesn't that mean that there's lagging indicators in these data points that you're looking at?
That's precisely the reason why we need to dig deeper concerning the labour market developments, and that's why we look at all possible relevant indicators concerning the labour market, wage growth, employment, unemployment, productivity growth, and it is clear that we've seen some decline in wage growth in Europe, but it has been rather moderate, rather slow, and therefore we have to also keep this in mind when we talk about inflation and disinflation in Europe. As I said, the big picture is disinflation, that's on track, but at the same time we still have some signs of higher inflation, especially in service and wage inflation.
You mentioned December before, and we'll see some updated forecasts at that meeting. But the language here that you've been using about we are determined to ensure inflation returns to our 2% medium-term target in a timely manner. Is it time to think about altering that phrase, updating it in December?
Well, our target is symmetric 2% inflation over medium term. And we are actually getting very close to that. We are, as discussed, we have now 1.7% headline inflation. Core inflation, neutralized from energy and food prices, is still above 2%. So we will certainly reflect the language we use, as we always do in the Governing Council meeting, in light of incoming data.
One of the big topics here at the IMF World Bank annual meetings is the fragmentation of trade. And this came up at the ECB last week as well, whether we could be looking at more trade tensions on the back of the US election. How are you thinking about that? Is it the impact on growth? Is it the impact on inflation, therefore on growth? I mean, how do we think about those looming threats?
It's actually both impact on inflation and on growth. I would say that the main reason now for this geopolitical uncertainty is Russia's illegal invasion of Ukraine and the war that is going on there, and the tragic war in the Middle East, as well as the tensions in the South China Sea. These are creating a cloud of uncertainty, which is felt very much also in Europe. geoeconomic fragmentation is a consequence of these geopolitical tensions. And of course, we are all watching with concern the political debate in the US presidential elections. The last thing we would need in this current context is a trade war. That would hurt the world economy, it would hurt emerging and developing economies, it would hurt all economies, including the allies of US in Europe. So the best thing to facilitate better growth and prosperity in the world economy is simply to avoid unnecessary trade wars. We have enough trouble otherwise already.
To that point, how painful would it be if we saw a repeat of what transpired back in 2016, where effectively, even though we are allies with the United States, there were trade issues with the US? How untimely would that be, given that there's a competitiveness issue in Europe, where everybody's trying to work out what to do with the Draghi report, how to change the game for Europe? How unhelpful would it be to see tariffs this time around?
We have several wars going on in the world, including in Europe and close to Europe. These are creating threats not only for European security but for world peace and for the free world. In this current context, indeed, the last thing we need is yet another trade war. Of course, in Europe, we have to be preemptively prepared for everything, for different options, and that's what we are doing. But we see that trade war would not really benefit neither the United States nor Europe, nor rest of the world.
Just finally, let me ask you again on interest rates. Is terminal and the neutral rate one and the same in this cycle, or do you see that terminal could be below neutral?
Well, the neutral rate is it's a very fascinating and important concept, and I think that the real natural rate of interest is a very important analytical framework for the economy, for thinking about the economy and monetary policy, but it is not a viable, concrete monetary policy instrument. So I look at estimates, and there are different estimates, very different estimates on the neutral or natural rate, but what matters for us is the inflationary outlook, underlying inflation, and the strength of monetary policy transmission. These are the parameters in our equation when we take decisions in monetary policy.
Governor, thank you very much for your time.